Good evening. On behalf of the World Trade Center, it is my privilege to welcome all the participants and the eminent faculties who are addressing for this today's virtual session for the webinar on transfer pricing in the COVID scenario. To give you a brief introduction of the World Trade Center, World Trade Centers are the international trade promotion organizations and are the licensed members of the World Trade Centers Association, New York. Having 320 WTCs spread over 92 countries, it acts as a facilitator to promote the international trade by providing trade education services, trade information services, arranging business-to-business meets, as well as the panel, as well as conducting various seminars of the current importance topics. This is one of the topics we jointly with ASA Associates presenting for the benefit of the business community. With this brief introduction, may I request Maloney to take over.
Thank you, Dr. Nair. Good afternoon, ladies and gentlemen. Welcome to our webinar titled Transfer Pricing in the COVID Scenario. Before we begin, here are a few pointers for the webinar. Please note that all participants will be in listen-only mode throughout the webinar. If you have questions or comments, please put them in the questions section in the chat. The presentation will be followed by a Q&A session. The link with the recording of this webinar will be emailed to you tomorrow afternoon. Kindly reach out to us if you face any difficulty with this. With this, I would like to hand it over to Mr. K. Venkatraman, National Head, Taxation, ASA and Associates. Over to you.
Thank you, Melanie. Thank you, Dr. Nair. On behalf of ASA and Associates, and in partnering with World Trade Center, we are privileged to come forward and do this seminar. Before I get into the overview of the webinar, I would like to give a small brief about what is our firm is all about, ASA and Associates. ASA and Associates started its journey 4 decades ago, and this is the 4th decade per se. We have 8 offices across India, 2 in Delhi, 1 in Mumbai, 1 in Ahmedabad, South, Bangalore, Kochi, Chennai, and Hyderabad. So totaling 8. About 700 professionals, 30 and odd partners, and many chartered accountants, more than 100 and odd chartered accountants working for the firm across all 8 offices. We have a deep connect with international business community, starting with Japan, Korea, European countries like Germany, Italy, Netherlands, UK, and USA. We have apart from the traditional assurance, we call it as an audit as well. We have taxation, both direct taxation and indirect taxation, and the head of direct taxation. And we have the accounting and business support services, typically is outsourced CFO services. So these are all the backbone of our firm services. We have, in addition to this, 2 more. One is a transactional advisory, which is into buy and sell of the company's due diligence, valuation, etc. And we also have business advisory services, mainly on inbound investments into India by the foreign enterprises. So with these few words about our firm, I thought I should first introduce the speakers. The title today is the transfer pricing in the COVID scenario. Actually, the transfer pricing is a part of the international taxation. Sometimes some words or some persons is caught up with the hero worship. So I have seen this transfer pricing has taken more prominence, though it is a component of international taxation. So to be very precise, we would like to cover the international taxation, but since the hero is very important, so we thought we should put the transfer pricing as our title. Especially with respect to transfer pricing, here is a person, Mr. Karthik, who is our associate director in Bangalore, operating out of our Bangalore office, and he has more than 10 years of experience in the area of direct taxation and the transfer pricing, and has been involved in advising and supporting large multinationals across industry verticals, including information technology, renewable energy, oil, gas, pharma, and on assignments covering advisory, dispute resolution, and as well compliances. Welcome, Karthik. Then, on the international taxation, Rizwan is going to talk. Mohammed Rizwan. Mohammed Rizwan has about 7 years of his background in direct taxation, and he's a deputy manager with the taxation function of the ASA Chennai office. He brings in with his lot of rich experiences in the area of direct taxation, transfer pricing, regulatory compliance, and his areas of expertise are assessments, appeals, advisory, and income tax related compliances, which have been offered to various Indian as well as multilateral firms in various sectors of the economy. So, welcome, Mohammed Rizwan. With this brief introduction, I will get to the overview of today's subject title. With the global economy already has been slowing down, witnessing a slowing down during the last 2 years. I'm talking about 18 as well as 19 or 1920 also. But the situation has been aggravated through the advent of novel coronavirus, COVID-19, which has spawned into a pandemic. COVID-19 created an unprecedented and extraordinary situation impacting the economic environment. What happened? The government wanted to contain the virus. So they wanted to close down all the, whether it is a business or non-business, all things were shut. And we first heard the name called lockdown of the entire country from the last week of March. This has resulted in the disruption of the business activity as a whole due to the shortage of material, labor, negligible demand, inventory write-off, unutilized capacity, liquidity crunch, and so on and so forth. There's endless. I can go on telling you. The companies are bound to report abnormal, absolutely abnormal, which has not been seen in my lifetime or anybody's lifetime over here. All this could eventually, but life has to go on. Let us understand. All this could eventually lead to significant impact on the transfer pricing and international tax side. In respect of multinational enterprises across the globe, including the business strategies, supply chain, profitability, impact on contracts within the MNEs, impact on transfer pricing of financial instruments, and treatment of extraordinary expenses arising out of this COVID situation. Here, with this overview, I invite my colleague, Mr. Karthik, to present his version of the transfer pricing. Over to you, Karthik.
Venkat, thanks for the introduction and setting the context. As Venkat mentioned, I will be touching upon some issues that we will want to highlight to all of you from a transfer pricing perspective. So I'd like to do this in say 2 phases. The first one will be highlighting some of the issues that we believe will largely impact many of the audience here, and secondly, I also see how we can address these issues. Next slide, please. So immediately jumping into the issues, we have tried to cover some of the illustrative transactions that we wanted to highlight or sort of touch upon during our discussion today. Given the economic situation, I'm sure these are some of the issues that many of the MNEs will be, the Indian subsidiaries of the MNEs will be facing, starting from inventory write-offs. Similarly, from a distributor's perspective, maybe inventory write-offs, then higher purchase costs, and maybe in some of the other service lines, service industries, companies in service industries, we can see issues relating to things like rent or lease cancellation costs, which can be substantial, where these agreements are cancelled, and at a time, companies may have to shell out up to 18 months of rent as a penalty for breaking off these arrangements. Or conversely, when companies decide to retain the office space, where in the anticipation that employees will come back to office in the near future, many of these offices will continue to remain empty or almost empty for some time to come in the near future, for next couple of months maybe, right? And in instances where suppose the companies decide to let go of this office space, all the investments that the companies would have made from a furniture and fixtures perspective will also have to be written off, and that will be a hit as well. Similarly, in instances where unfortunately where some companies may have to let go of some people, they may would have to give out severance packages to its employees, and again this will, depending on how large the impact is, the cost can be significant. One of the other things that we've also seen that companies do or have been doing in the last few months is to enable employees to work efficiently from their homes. We've also seen companies making arrangements in terms of supplying, let's say, laptops, chairs, desks, Wi-Fi routers, such similar, IT hardware equipment and other equipment to employees to make them work efficiently. And in instances where, let's say, companies have an accounting policy to depreciate assets which are not more than 10,000, or sorry, not write off, not capitalized assets which are not more than 10,000 in cost. If there is a huge chunk of purchases that may have been made in this current scenario, all of this cost, when it hits the P&L, it can be a significant cost. So ideally, these are some of the, as I said, these are illustrative. This may not be, this is definitely not exhaustive. Depending on the business that we are in, there can be other such costs which will also have to be looked at. And all of these things have a direct impact on the P&L, on the bottom line, and the cash flows. Also, specifically in the scenarios of cost, intercompany arrangements, where in cases where, let's say, the companies are operating in a costless kind of a pricing arrangement, the question will be, what do we do with this cost? Should we be including it in the cost base? And would therefore not the cost base be impacted significantly as compared to a normal business scenario. The other thing that we also want to touch upon, given the current situation, is or be mindful about is of the deemed international transactions provisions or regulations. This is nothing new. This has been in the regulations for some years now. The reason I just wanted to highlight this specifically for the purpose of our discussion is the fact that though these transactions may not have happened in the past, given the situation, like going back to my earlier point where companies have had to make bulk purchases in terms of IDA hardware, equipment, etc., where they may have found it difficult to manage to get these on their own. They may have depended upon or leaned upon their group companies or their parent company to make such arrangements with vendors that the group companies work to make such supplies in India as well. And in such instances where, if suppose the transactions, the terms and conditions of such purchases have been influenced or negotiated by the group companies, this can be a potential transaction which can be classified as a deemed international transaction. So just wanted people to be mindful about any such purchases that they may have done in this last 2 months or so, which may have had such impact, and look at it in more detail to see if suppose these regulations get triggered. Next slide, please. Similarly, one other thing that we would also want to highlight is impact from a financial transactions perspective. What we mean by that is we've seen again in an intercompany arrangements, companies will have mentioned credit periods that they would want to adhere to in terms of settling intercompany payables and receivables. Typically, we may see that to be between say 30 days to 90 days. Again, considering the impact of cash flow, the question will arise whether companies in practice in this current situation will be able to meet that credit period that they have contractually agreed to adhere to. The reason why we wanted to highlight this is because in the last few years we've seen during transfer pricing assessments, the tax officers making a specific inquiry about whether the companies have adhered to this credit period that have been extended, and if they have not, have imputed notional interest and made adjustments to the income of the assessee in India. So therefore, that is something that you wanted to highlight. Similarly, given the economic scenario, we also wanted to highlight of instances of where companies there exist intercompany loan arrangements. We've seen that the governments and the banks and the financial regulators across the world have made various provisions and policies in this current scenario where they've allowed for moratorium on loan payments or even allowed for restructuring of loans. As we all know, loans are the interest rates on loans are a factor, are factored by the credit worthiness or the credit ratings of the borrower. So given the current situation and impact of the current situation on the credit rating of the borrower, this can be an ideal opportunity for companies to relook at their intercompany loan agreements and see if they would want to make any adjustments which can which are suitable to the current situation and as well in the near future as to how the given how the impact is going to be over the next 12 to 18 months as well. The other thing that which possibly would not have happened again ideally in the past and something may have been become a necessity or an option at this point of time is in instances where of course there are no intercompany loans. Even then, there may be instances when a group company may say or a parent company may say that, well, I may not extend the loan to you directly. You may approach a bank to take some loans to fund your working capital requirements at this point in time, and if required, we'll be willing to extend the corporate guarantee from our end. And in such instances, if there are any charges being paid to the parent company, that's also something which ideally may not have been a transaction that had to be necessary in the past, but may have been entered into at this point in time. So that is something we would also need to be looked at from a transfer pricing perspective. The other thing that I also wanted to touch upon is in other intergroup transactions in terms of royalty and management fees. The reason I wanted to touch upon these as well is the fact that we've seen that even in normal circumstances, these transactions have been highly litigative. Tax authorities have challenged these payments, even in instances where companies have had good profitability. So, especially in the current scenario where there is a possibility that companies may have a red bottom line, there may be questions around whether whether such payments should happen in the current scenario. Next slide, please. So now we've looked at some of the points or transactions which we believe, first, as I said before, this is illustrative, which I'm sure many of us would be facing. Now the question will arise, if any of these have an impact on me, how do I go about addressing these? We believe these need to be done in a three-step process. The first step would be for companies to really, make an analysis of what is the quantum of this cost, what are the what is the actual impact on the profit and loss account and on the cash flows that the companies will face in terms of let's say including this in the cost base, for example expenses like additional rent expenses or write-off of assets that you talked about, etc. And also in terms of making payments of royalty or management fees, which possibly can be the difference between a company reporting a profit or a loss in this current scenario, maybe in many instances. So the first step would be for companies to really make a clear and assessment about how deeply these transactions have an impact on their financials. The other thing that we'll need to also be mindful about is, somebody can always say, why is it that we need to look at it a lot more closely at this point in time? Let's say these are transactions that we have always been entering into, let's say a royalty or a management fee or an interest transaction. Similarly, even rent expenses or severance, these are things which are possibly just normal costs that any business would incur in a normal business scenario. So why do we have to relook at this specifically from a COVID situation perspective? I think the reason why we need to look at it is because the situation itself does not make these costs to be abnormal, but they have possibly become a bit abnormal because of the unusual circumstances that we are in. So that's the distinction we would like to make. So though there may be many of these expenses which are possibly normal and repetitive in nature from a normal business scenario perspective, just because of the fact that there is a situation today where any costs which we will be impacting, and this can be significant in terms of, as I said, about writing off assets or purchasing of assets or even the deposits, inventory write-offs, for example. So while all of this can be a normal part of the business that we would have been undertaking, the impact of that can be abnormal on the financials because of the unusual circumstances that we are in, and therefore this will need a closer look from the current situation. The next step is that once we've analyzed this and really understood how really it impacts, the next step would be for us to suitably amend our intercompany arrangements or agreements, because that is the base document for our contractual relationship between the group companies. So that is like the mother document, and all of our transactions are those. The issue is, why do we need to again relook at the agreement specifically, is because in such instances where we believe these are having an abnormal impact on our financials and are significant, and if we want to make any modifications to these arrangements, the only way to effectively implement it is by modifying our agreements, be it, let's say, an instance where we will say that we will not charge markup on this cost in a cost-based agreement, for example, or we will not take the impact of inventory write-offs in a limited test distributor kind of a scenario to compute what should be the minimum margin that the distributor should be making currently, or the impact of the royalty, etc. So any of these things that we will need to make any amendments, it has to be by way of modifying the intercompany agreement suitably. And in this, what I would also like to highlight is that when we are making such amendments or modifications, I think companies also need to be mindful about whether that such modifications are not made from an immediate impact perspective, but use this opportunity use this situation as an opportunity to anyway amend it and do it from a future proofing perspective. Now, what I mean by that is that when we make these modifications, let's not be maybe specific to say that I'll only exclude this cost or X cost or Y cost, but probably bring in scenario in the arrangement such that whenever there are such unforeseen and unusual circumstances that companies may face in the future as well, there is enough flexibility in these agreements to be able to immediately make suitable arrangements when we have to conduct business going forward, and not having to retouch the agreements every time, so or remodify the agreements every time. So meaning that the language can be such that we will possibly say that subject to such an event happening, or subject to any such natural calamity happening, for example, or such things happening, we may be flexible enough to say that the companies will identify among them to see what are costs which may be abnormal, that may be impacting, and therefore then we will decide whether we will do a markup on this cost or not, or maybe on a conservative basis at least receive a cost to cost reimbursement, so that then is balanced out from a tax authorities scrutiny perspective as well. The third important step that will have to be done is documenting all of these in the transfer pricing documentation, because as we all know, the first thing that the transfer pricing officer will want to look at and analyze is the transfer pricing documentation, because it is in this documentation that the companies are required to list out the transactions that have entered into, and also justify the arm's length nature of these transactions and the treatments that have been made in respect of such transactions, to be able to justify why they are at arm's length. For example, as we were discussing about, let's say, the rent deposit write-off, which will need to be, which possibly is high. Now, if the company decides that, though in normal circumstance, I would include rent in the cost base and then do a markup, but in the current instance, if suddenly if I had to pay a 12-month rent at one shot to be able to cancel my lease, and if I decide not to charge a markup on this, I think it's advisable and that the company specifically highlights that this transaction has happened only for the reason that of the unusual circumstance that we are in, and therefore instead of doing a cost plus on it, we have decided to do only a cost to cost reimbursement, for example. So it is better to contextualize the reason why we are doing or treating a particular transaction in a particular way and justify it, and then also support the arm's length nature by doing appropriate benchmarking. I think I would not I would like to really stress upon these two aspects of looking at the agreements and the documentation, because these are the things that the company the tax officer will scrutinize to be able to then and decide whether they will accept your contentions or not. I think I would want to again highlight the significance of this reason is because I would want companies to be proactive and do this at the time during the year, for the reason that if suppose we do not spend the time and make this documentation robust enough at this point in time, tomorrow 2 years down the line, when possibly things hopefully would have all become normal, and at that point in time, if we would want to go back 2 years back and understand why we did something or not, and then if not been documented sufficiently at that point, at the current moment, then it will become a challenging proposition for the companies to be able to justify all of these stands that may have been taken at this point in time at a future date before the tax authorities. So I would strongly urge companies to really be focused on these and make suitable arrangements to ensure that whatever is that we decide to do is completely documented and justified well in terms of both my agreements and in my transfer pricing documentation. One last thing that I would want to touch upon also is for companies which have entered into APAs, As we all know, APIs are when they are entered into subject to certain critical assumptions being met and certain terms and conditions being met, and because subject to which the agreement would have been entered into. One example that I can immediately think of, which I've known being used as a critical assumption in again a cost price kind of a scenario, is credit period, the one that we touched about a little earlier. Again, as I mentioned, where suppose given the current cash flow situation where we believe cash flow management is an issue and we may not be able to meet, let's say, a 30-day or a 15-day credit period that we may have agreed to with the government at the time of entering into the APA, we would urge companies to proactively again reach out to the APA authorities and request for a modification of their APA such that and can gain some and request them to make suitable modifications, even if it's a temporary measure, to say that maybe for FY 2021 we will not adhere to the 15-day credit period that we've agreed to because of the circumstances that are there. And then maybe we can, from the next year onwards, it can come back to the normal agreement that we've had. So the reason I would want to again suggest companies do this proactively is because, one, there is a provision to make modifications to the agreement by way of request. Two, any such requests, if modifications, if they are not made, and at the same time we are not able to comply with these requirements at the time of a compliance audit, if such issues come up before the tax officer, and if they send any negative inferences on account of not meeting these requirements, the government has also the power to cancel the AP agreements. So all the efforts that we would have put over the past many for at least a year or two, as we know the time that it will take for an APA to be entered into, all those efforts will become nullified just because we probably chose not to be proactive at this point in time and make these suitable modifications. So that's something again that companies will need to be mindful about. So with this, I would request Rizwan to take forward the discussion. Over to you, Rizwan.
Thanks, Kartik, for the presentation and setting the tone of the section. Good evening, everyone. This is Rizwan. So, followed by transfer pricing, there also be certain international tax aspects that requires consideration. For example, certain individuals who would have been come to India and got stranded in India on account of the lockdown. So, these might have some tax repercussions in India. So, accordingly, my areas of coverage would be risk of permanent establishment, risk of place of effective management, and risk of dual residency. Next slide, please. Next one. Yeah. Our first slide is on risk of permanent establishment. So for convenience purpose, I will refer permanent establishment as PE. So to start with, what does a PE mean? PE means, a PE basically means having a taxable presence outside the company's state of residence. So types of PE as per a DTA typically would include a fixed DTA, in a sense double tax avoidance agreements that is entered between the countries for avoiding double tax. So this includes fixed place PE, service PE, dependent agent PE, and a supervisory PE. So what is a fixed place PE? Fixed place PE means having a fixed place at your disposal for performance of business activities. It is not necessary that there must be a big corporate office set up to consider fixed place PE. Even a small room of 10 by 10 is suffice to consider fixed place PE. In terms of service PE, when an employee comes to India for rendering, employee of a foreign company comes to India for rendering official services and his stay in India exceeds a threshold as prescribed in the DTA, then it will establish a service PE. In terms of dependent agent PE, when some persons concludes, either secures or concludes contracts on behalf of the foreign company, dependent agent PE might be established. In terms of supervisory PE, this is in connection with the supervisory activities rendered for some building site, construction site, or assembly project, and his stay in India exceeds the prescribed threshold as per the DTA. So now let's see how COVID-19 has impact on each category of PE. The first one being fixed place PE. In this case, the employees who have come to India and stranded in India might be working from a hotel or office accommodation or a guest house, and this could be viewed as a fixed place PE. as he has some fixed place for disposal of the business activities. For instance, a Chinese-based holding company, Chinese-based holding company having a subsidiary in India, an employee of a Chinese company comes to India for some short-term official visit. However, on account of this travel restrictions, he was forced to stay in India, and the Indian subsidiary has allotted him a small space for disposal of his business activities. That is, business activities of the Chinese company. So, in this case, it could be viewed that Chinese company had a fixed place P in India. In terms of service PE, the employees who are stranded in India might have to stay more than the planned period in India and thus exceed the prescribed threshold as per the DTA, thus posing a risk of service PE. Coming to deputy agent PE, the employees who are representatives of the foreign company during the period of lockdown, that is during the period of their stay in India on account of the travel restriction, may be forced to conclude some contracts in India and hence could lead to a potential risk of dependent agent PE. Coming to supervisory PE, in line with the service PE, if the employees stay exceeds the prescribed threshold as per the DTA, this could lead to a risk of supervisory PE being established in India. Next slide, please. With this, we move on to next slide on withholding tax dilemma. So, existence of a PE might as well affect the withholding tax rates. So, normally when an MNC renders some technical services, it is taxable at the rate of 10%, or it renders some technical provides some technical know-how, it is taxable as royalty at the rate of 10%. But when a PE is being established, it will be taxable at the rate at which a foreign company would be normally taxable, that is at the rate of 40%. And the worst part is the WHT, that is the withholding tax rate, is leviable on the entire consideration and not the profit part alone. So what would be the options available to the seller? So first one being, he may provide a no PE declaration to the buyer and demonstrate that make him convinced that only an inadvertent PE is being established on account of exceptional circumstances, and make him take a rational decision by deducting tax only at the rate of normal rates, that is 10%. Or second case, he may put up a case before the tax officer and demonstrate that there is no PE and obtain a lower deduction certificate. So obtaining a lower deduction certificate is a separate process by itself. So what would be the possible view of the tax officer in absence of any CBDT clarification? CBDT is a central board for the benefit of all. CBDT is a central board of direct tax, that is a tax body that settles the tax matters in India. So the tax officer could provide you relief and grant you relief giving a lower deduction certificate, but obviously he will be requiring sufficient and comprehensive documentation in this regard. Also, a management declaration and a professional opinion could also help in this regard. But it also goes without saying that tax officer also possesses the right to reject our application. So whether net of tax contracts are impacted, the answer would be no, because in those kind of contracts, the seller would be entitled to a fixed consideration irrespective of the tax component. That is, the tax liability would be borne by the buyer himself. So any shrewd buyer for that matter would not be willing to face the tax brunt of 40%. Next slide, please. So with this, we move on to the next slide of risk of place of effective management. So for convenience purpose, I'll be referring to as POEM. So what does a POEM means? POEM means the place where key commercial and management decisions are made. So the CBDT has provided guidelines for determination of POEM. So the critical factors for determination of POEM includes active business outside India, location of board meetings, that is where predominantly the board meetings are held, and the place where key management and commercial decisions are made. So usually these kind of decisions are made by persons called as key managerial personnel, which includes CEO, CXO, and CFO and managing director. So on account of these travel restrictions, these KMPs might be grounded in India and maybe sometimes forced to take some key management decisions in India, which could lead to a POEM being phased out of India. That is place of effective management being placed in India. So what if a poem is placed in India? The poem could be taxable at the rate of 40%, and the second thing is it has a far-fetched impact. The second thing is its global income would be taxable in India. In this regard, OECD, that is Organization for Economic Cooperation and Development, the international body that sets the tax standards such as BEPS action plan, has come out with a detailed guidance now stating that PE and POEM shall not be created in such exceptional circumstances. For the fact to be noted that India is not a member to the OECD, and adopting this piece of advice from the guidance note would be a bit litigative. Further, this is proven by the fact that our CBDT has not provided any circular or guidance note in this regard. Next slide, please. Risk of dual residency. So a person's residential status is determined based on his stay in India, number of days stay in India as provided in the Income Tax Act. So on account of these travel restrictions, certain individuals who have come to India might be stranded in India on account of this lockdown. So normally, which could make him a resident as per the income tax purpose, Indian income tax purpose. So normally two situations might arise. So first one being, let's say an NRI based out of US comes to India for a short-term official or personal visit and gets stranded in India, and his stay exceeds the prescribed threshold as per the Income Tax Act, which could make him a resident as per the income tax laws, Indian income tax laws. The second one, let's say a US citizen coming down to India for a short-term visit, and on account of lockdown is grounded in India. This could also make him a extended stay. The extended stay could make him a resident as per the income tax laws. So the guidance note which I was referring to earlier, that is the guidance note provided by OECD, has considered this aspect as well, and has stated that this extended stay shall not be considered for determining the residential status of the individuals. Fortunately, India has also adopted this piece of advice, and CBDT has provided a guidance note that this extended stay, the extended stay from March 22nd to March 31st, shall not be counted for determining the residential status. So this circular is provided for FY 1920. So on similar lines, we may expect a circular for FY 2021 as well. Next slide, please. Next one. Extension of due dates for companies for litigation. This has nothing to do with international tax, but just thought of sharing a glimpse of how the COVID impact on had on the due dates and for complaints as well as litigation. So our Honorable Finance Minister has stepped in and announced various relaxations, not only from a direct tax point, but as well as from indirect tax point. And further, RBI also relaxed the installments in terms of working capital loans as well as term loans. So initially the extension was provided for a period till 30th June 2020. That is, any complaints that fell between the period 28th March till 29th June had the due date till 30th June 2020. However, considering a situation that it didn't restore normalcy and was not expected to restore in the near future, the extension was further extended to 31st March 2021. That is, whatever complaints that fell between the date 28th March and 31st December will have an extended date till 31st March 2021. However, there were carve-outs for these, like return filing dates and tedious return filing, income tax return filing dates and tedious return filing dates have the specific dates mentioned. But matters like assessment and appeal will have an extended date till 31st March 2021. So what will be the impact on safe harbor rules? Safe harbor rules basically means the circumstances in which the transfer price as declared by the assessee is being accepted by the transfer pricing officer. So transfer price in this regard means operating profit margins, which are specified for various industries such as software development, auto, ITI, and ITES. So these operating profit margins, that is the safe harbor rule rates, are notified for a period of 3 years. However, recently this has been notified only for a period of 1 year, that is for assessment date 2021. So this arises the curiosity that whether these operating profit margins will undergo a revision due to the disruption caused by the pandemic. Certain MNCs have to prepare CBCR, that is country by country reporting, as part of the TP compliance. So we have to check whether any extension in the parent company's jurisdiction will have an impact on Indian subsidiary. Next slide, please. This slide is just basically the comparison between the existing due date and extended due date. So the due date for income tax return, which was earlier provided till 31st July for individuals, and for non-individuals 31st October, was extended till 30th November. And Vivace Vishwas was extended from 30th June to 31st December. And assessment for TP cases, non-TP cases, was extended from 30th September till 31st March. And appeal, it depends on what appeal you file, whether CAT or ITAT. But the blanket date, extended date, was provided till 31st March. And date of commencement of operations for an SEZ unit, which has obtained approval before 31st March, as due date got extended from 30th June to 30th September 2020. So that's it from my side. Thank you. Over to you, KV sir.
Thank you, Rizwan. Thank you, Karthik, for the very good presentation. I think, as I told you, that the hero has got its share here, the transfer pricing. Many questions on that. The question says like that: please go into some detail on types of TPAs possible, within bracket, fixed price, cost plus, etc., and typical allowed ranges by RBI for these kind of arrangements. RBI or IT? I think income, for the purpose of income tax, because the prerogative of the transfer pricing officer is to accept or not. So I think the person who was the queries must be by income tax. Anyway, this question is to Mr. Karthik. Karthik, I hope you got the question right.
Yes, I did understand the question, Venkat. Thanks for that. I think it's a bit difficult to be able to give a generic range in terms of even a cost-plus arrangement or otherwise, because depending on the nature of services being provided, these can change. For example, in a software development, maybe an X percentage. For an ITES, we may look at a different percentage. For a KPO, we may look at a different percentage. From a contract manufacturing perspective, where also we can have cost plus arrangements depending on which industry the manufacturer is in. Again, the percentages may change. I think the best way to look at what percentage may be adopted will be to do a bit of an analysis of what is the nature of the transactions, the industry in which the company operates, and be able to do a benchmarking. But anyways, just from a reference perspective, let's say for a software company, we may look at something between say at around 15% maybe, and maybe for a contract manufacturing, depending on what sort of industry it might be, maybe a 10% rate may be appropriate. For a KPO, maybe the number can be between, let's say, 17 or 18%. But as I said, these are not numbers that I would suggest that company should adopt blindly or take it as a reference point, as a fixed reference point. I think the solution would be that the company should do a benchmarking and then see for themselves what I think is the best markup that they should be using given their set of their business and their economic conditions.
Yeah, good, Karthik. Actually, I would like to elaborate in the sense, what Karthik is, there is no fixed prescription for the ranges. It depends on the circumstance to circumstance or the company to company, and yes, definitely on the downward revision is possible if you are able to have the proper backup and documentation. Is that right, Karthik? Karthik?
Yes, Venkat. A downward revision may also be possible, but there has to be a substantial situation which will have to be documented, explained, justified as to why there's been such a big impact, and then given that situation, companies may relook at revisiting their markups if they would wish to. But in the hindsight, I think the company should be mindful about the fact that even with their best efforts enough trying to do it, they can possibly still be this be challenged by the tax authorities. But of course, there is no restriction if the company would, because of the situation, necessitate change in their markups.
Okay, great. Thank you. One more question. Would like to know the transfer TP outlook of the transactions with respect to India, Singapore, Dubai, and the USA. Again, I repeat the question. Would like to know the TP outlook of transactions with respect to India, Singapore, Dubai, and the USA. Again, it's a very generic question, but anyway, Karthi, to you.
Yes, Venkat. I think as you rightly mentioned, it's quite generic. I think whenever we do a pricing arrangement between the India entity and, let's say, wherever the parent entity is, the reference point will be the economic outlook or the situation in the country that we are in, which is India. In fact, therefore, even going back to the earlier question, it is the benchmarking which will ideally determine of Indian comparable companies, which will determine what will be the markup that may be used for a particular industry or transaction per se. So to that extent, at least from an India perspective, while we may, I mean, to me the question is whether would I, if I'm a contract manufacturer in India operating in India, would my rate differ just because the purchaser who is my related party is in US or Singapore? Ideally no, because whatever the rate that I might decide to enter into with these countries is largely guided by the fact as to how comparable companies in India would be operating, because that's again what the Indian tax authorities would be expecting. So in fact, also because of this, I mean, I'd also want to just touch upon this fact that therefore, I think I would urge companies to be cautious about wanting to relook at their markups in this current scenario, for the simple reason that while of course there has been an impact in the first 2 quarters, we are hopeful that things may come around and hopefully sooner, and we don't know how things will stand by the end of March 21. And let's say companies decide to make any changes or downward revisions, for example, in their markups, and at the end of, let's say November or September 21, when we are doing the documentation for 2021, if the benchmarking process does not support these downward revisions, it may end up being a double whammy for the companies where, while they choose to reduce the markups, but the benchmarking may not necessarily support it, and then it can become a tricky situation. So I would urge companies to, instead of looking at making adjustments to their markups, do a little more analysis and look at making any adjustments to their cost base instead to address the current economic situation, so that they can balance it out.
Yeah, actually, what Karthik says is there are some one-off such transactions which has impacted due to this COVID. That could be, that could be transmitted between the companies at cost to cost. Of course, backed by appropriate documentation, so that the benchmarking will not pose any problem at a later stage when you are sitting down and doing the TP study sometime in October, November of 2021. You're right, Karthik. Thank you. Let me, I think I have seen one or two questions in international taxation. I don't know, it's 5 o'clock. Yeah, I think in international taxation, is there any relaxation, whether any relaxation given to construction PE? This question is to Mohammed Rizwan. Rizwan, over to you.
Yeah, Kaiser. So as per the OECD commentary, if you see that any temporary interruptions will not affect the life of a site, that is a construction site. So temporary interruptions which they have given as an example or shortage of material or labor. And the guidance note which I have referred to, which I referred to in the discussion, that also talked about construction PE. And what the status these they have considered this COVID-19 is also as a temporary interruption, and has stated that this shall not be excluded for the determining the construction of determining whether a construction PE is being formed or not. That is, say for example, if the lockdown is in effect from April to June. So these 3 months also should be included for purpose of determining whether a construction PE is formed or not. So obviously this was not in line with the other relaxations given to the other PEs. Yeah, it's a bit unfair from at least from my opinion, it's a bit unfair towards the construction PE.
Yeah, I do agree. This looks little illogical, but let us wait. Some better sense may provide. But as of today, your answer is no. Such period of lockdown will also be considered. Will have to be computed for the purpose of arriving at the PE. Is that right? Correct?
Exactly.
Okay, great. There is one question to Karthik, very interesting. If a parent provides loans to its subsidiary for the operating expenses, as the subsidiary is underperforming, number one question. The main thing is, if the parent provides loans to its subsidiary for their operating expenses, as the subsidiary is underperforming, maybe at a loss, 1. Can the interest rate be at 4%? 2. Can the loan be converted to additional share capital as the subsidiary is not able to pay the principal and interest? There are 2 questions. One is, the subsidiary is underperforming, parent is making funding the subsidiary in India for meeting their operating expenses. The rate of interest, whether it can be at 4%. That's the question number 1. Question number 2 is, can the loan be converted to additional share capital as the subsidiary is not in a position to meet the repayment towards the principal and interest? Question to you, Karthik.
Thanks, Venkat. So yes, this is in fact one of the things that I in fact touched upon earlier in my discussion as well. I think if the companies are open to, as a first option, if the companies are open to, or the parent is open to converting this loan into an equity, I would suggest, of course, subject to regulatory requirements and approvals, etc. Of course, there will be no restriction on they moving ahead with this option of converting the loan into equity. The second question is on the rate of interest. Now, again, as I mentioned, the rate of interest is a is determined by depending on what is the credit worthiness or credit rating of the borrower. Now, again, of course, I'm not sure what is the rate which was originally that now being suggested if it can be 4%. Courts have consistently held that wherever there have been loans coming into India from overseas, the benchmark that has to be used is the currency nominated LIBOR rates as a base, for example, and an appropriate spread. So in such instance, even if suppose you would want to make any changes to the interest rates compared to previously, let's say if you're saying 4%, I'm assuming if you are saying that you're going to reduce from 6% to 4%, for example, then till the time that can again be supported by appropriate benchmarking, there should not be any challenge in doing that.
Okay. Great. Thank you. I think I can have one more question. One second. Somebody asked for the simple question is simple, but taxation implications of online business. Probably they must be referring to Google Tax or the equalization levy. I'm not sure, which we have not touched upon because this is a separate subject matter altogether. So he has asked a question. Would Karthi be interested in answering this question? It's a big, generic question, but again, this is not the one which we have touched upon. You can.
Yeah, quickly, as you rightly said, I think that topic is probably another hour session by itself that we feel if we need to do it. But quickly, I guess if it refers to the new additional levy that has been introduced through the budget provisions this year, I believe the finance ministry has stated that at this point in time they are committed to keeping this levy at this point in time, and as such they have not made any concessions in terms of either rolling it back or deferring it or any such thing. So specifically from a COVID perspective, impact perspective, I believe even with the scenario, I believe the government has still stuck to a stand of wanting to retain this levy that they have introduced. So now what the implications can be, whom it applies and all of that, I think it's a separate discussion by itself. And it requires substantial time to be, for us to go through it. So, but therefore I limit my answer to the what I've said at this point.
Thank you, Karthik. I think we are upon time is we have crossed about 7-8 minutes. So let me close this. Though there are about some unanswered questions, 6 to 7 questions, and many more questions might be there. Who are definitely you are welcome to send it across. And with this, let me go into the closing this webinar. I thank both the speakers, Mr. Karthik and Mr. Mohammed Rizwan, for their wonderful presentation and also coming out with the response to the questions raised. Thank you, Karthik, and thank you, Rizwan. I thank the organizers and with whom we have done the knowledge sharing session, WTC. Let us hope we will do much more vigorously on many other subjects from our side. We are keen to be your knowledge partner. Thank you, sir. Thanks for all our team who have done enormous amount of support, both from upfront as well as back end. To name a few, Manoj, Melanie, our Vivek, and Mohan. Last, I thank profusely the audience, the participants, but for you, this would not have been successful. Thank you so much. And we will be sending you the link of the recording to everyone who have registered and who are part of this webinar. I'm sure that unanswered questions and also any questions which are going to be sent to us will be answered, and all of you are going to get both question as well as answer. That means even if you have any questions which you have not written, please write and please send it. Thank you very much, sir. Thank you all.